Hello everyone. Welcome to our discussion sessions on official mock exam issued by ACCA for June 2025 exam attempt for our advanced taxation course. In our today's class, we will be starting a debrief session on this official mock exam starting with question number 1 of this paper. I'm your tutor, Owais Mirchawala, and our today's class will be a very detailed session on the development of answer and discussion of this complete question number 1. In my series of past paper discussion sessions, I will be looking at 6 complete attempt exam papers in which we will be understanding that how you have to deal with your actual exam paper. It will give you an idea that when you go for your actual examination, how you have to apply all of the topics together, and then most importantly about the time management skill. Okay, while discussing this past paper, we will be using this life-saving summary notes, which I have developed for the students, in which I have summarized the entire course in just 57 pages. You can use these summary notes for any topic you want to refer, like for example, if rollover reliefs come, you just type search rollover and you can find the relevant topic. Or for example, if it's capital gain tax, you simply write capital gain tax and you go to the relevant topic. Okay. So these summary notes are very essential in your finalization phase of exam preparation. So let's start with the question number 1. We will be first reading this question number 1. We'll analyze the entire data. Then we'll be looking at all of the exhibits requirement. And then at last, we will be drafting the complete answer in our today's class. Your patience and concentration throughout it will be really important. Let's start with the reading of the question. You should assume that today's date is 1st June 2025. You are an ACCA student working for a firm of accountants. Your manager has asked you to carry out some work in relation to ACCA Limited Group of Companies and personal tax affairs of the company's managing director, Morwin. In addition to some ethical considerations which have been raised by your manager, advice is required in respect of. See, this is the basic introduction of the question in which the examiner tells us about his expectations in the question. Like when we are reading it, we can identify that, okay, there will be a requirement relating to ethics, and then these will be the list of requirements. When you're reading the question for the first time, it's very important that you read it with patience and concentration. Don't rush, otherwise you will get frustrated, you will feel pressurized that, okay, there is something difficult in it. Believe me, every question is easy. It's all about that how you approach that particular question. Now, the use of brought forward trading loss and capital loss by a newly acquired subsidiary company. The corporation tax and value-added tax implications of a sale of building by a company to another company in the same corporate group. A group company becoming member of group VAT registration, the write-off of a loan made by a company to its shareholder, and the calculation of employment income benefit in respect of a company car. So if you look at this question, see, this is what happens in actual examination. That a lot of topics come together. You have to think about ethics. You have to think about brought forward trading loss reliefs. You have to think about the transfer of asset within group company. You have to think about group VAT registration. You have to think about closed company implications when a loan is written off, which was given to a shareholder. And then you have to think about employment income also. See, what normally students do is that they study a particular topic and then they do past papers along with that. Doing the past papers at that point of time is very easy because the topic is fresh in your mind. But when you go for your actual examination, it's not each topic coming separately. It's everything coming together. And at that point, it's very important that you can connect the dots. You are able to connect all the topics together. And at that point, the students get pressurized. They feel frustrated. Okay. So these complete past paper discussion sessions train you for that entire activity. The following exhibit available on the left-hand side of the screen provides information relevant to the question. The ACCA group of companies memorandum from your manager. Replacement of company car email from Morwin. Work to be carried out email from manager. The information should be used to answer the question requirements within your chosen response options. There are two response options. There is a word processor, which we use for the drafting of the answer. And then there is a spreadsheet, which is used for the calculation purpose if you want. Otherwise, you can do the calculations on word processor also. While we'll be solving the answer, I will be illustrating that how you have to use these response options. Okay, so there's nothing to worry. You just need to listen to me carefully with patience and concentration. Let's start with the first exhibit, Exhibit 1, the O'Clocky group of companies. Now, extract from the manager dated 1st June 2025. The memorandum records a telephone conversation with Morwin, the managing director of O'Clocky Group. Background: Morwin owns 55% of the share capital of O'Clocky Limited. See, if one shareholder owns more than 50% shares, it's a situation of closed company. Five or fewer shareholders. Please listen to me. Five or fewer shareholders controlling a company makes it a closed company, a friends and family company. Okay, I hope you remember. If you don't remember, just go to the summary notes, right? Closed company, and you will find the relevant rules about the closed company rules. Okay, close company or a friends and family company. Here you go. Close company or friends and family company is a company which is controlled by five or fewer shareholders. Obviously, if controlling shares are owned by a single shareholder, so it's less than five shareholders. The remaining shares are owned by a large number of members of Morwin family and also by unrelated business associates. The principal reason for our conversation was to discuss O'Clocky Limited's planned acquisition of the ordinary shares in Remoil Limited. Morwin also told me that O'Clocky Limited was considering writing off an outstanding loan made to one of its shareholders. See, we are going in the depth of the scenario. It's again important that you read with patience, try and identify maximum possible data so that you can deal with the scenario in a better manner when we look at the requirements. The O'Clocky Limited group of companies. O'Clocky Limited owns the whole of the share capital of Kilbride Limited. Both companies are UK resident trading companies which prepare accounts to 31st March each year. The two companies are registered as a group for the purpose of VAT value-added taxes. So O'Clocky is owned 55% by Morwin. Morwin is an individual who owns 55% of O'Clocky, and O'Clocky owns 100% share, whole of the share capital of Kilbride Limited. So basically, O'Clocky and Kilbride are part of a same group. Okay, planned acquisition of shares in Remoil Limited. It is intended that this acquisition will take place during the current year ending 31st March 26. Depending on the outcome of the negotiation, O'Clocky Limited will either acquire 60% or 80% of Remoil Limited's share capital. See, if we acquire 60%, we cannot form a capital gains group or a 75% group. You all know. Because for both of the group, direct ownership requirement is 75%. But if we acquire 80% of the shares, we can form a capital gains group and a 75% group. With 60% or 80%, you get a control. But for the tax groups, for capital gains group and 75% group, you need at least 75% ownership, which will be satisfied if we acquire 80% shares at least. Remoil Limited. Remoil Limited is a UK tax resident company which trades in UK and prepares accounts to 31st of March each year. In the year ended 31st March 2025, the company's turnover fell to a very low level and has not yet recovered. Remoil Limited made a tax adjusted trading loss in the year ending 31st March 2025. £70,000 of this loss is being carried forward as at 31st March 25. So we are planning to acquire shares of Remoil Limited, which has some brought forward trading losses. So now my mind starts to work. It's a situation of we can say the pre-entry losses. In the 75% group and capital gains group, in both of them, you study the pre-entry losses. Because Remoil Limited has a trading loss brought forward 70,000 pounds as at 31st March 25. We are acquiring it on 31st March 26, so there is some old loss coming forward. Remoil Limited has a capital loss of 47,000 pounds to carry forward as at 31st March 25. So from old years, the losses are getting brought forward. It will enter our group in 26. So these are what we call as pre-entry losses. Okay. Remoil Limited makes wholly standard rated supplies and accounts for the VAT under the flat rate scheme. Following O'Clockey Limited's acquisition of the shares in Remoil Limited, Morwin intends to re-establish and grow the trade of Remoil Limited. The Remoil Limited has fallen down to a very small level. It has fallen down. Morwin will rebuild it, what we call as revival of trade. So why are you emphasizing on this word? If you remember, there was a loss relief restriction. If there is change in ownership along with change in activity includes revival of trade, a loss relief restriction gets applicable. So I don't remember those rules. Let's go and write loss relief restriction. Okay. Now, in the loss relief restriction, if you remember, if there is a major change in activity includes change in primary activity, change in target market, or revival of trade, along with major change in ownership, which is transfer of 50% or more shares. So here, Romoil Limited's more than 50% shares will be transacted. Its trade will be revived. Change in ownership, more than 50% shares. Change in activity, loss relief restriction gets applicable. Okay? Morgan intends to reestablish and grow the trade of Remoil Limited. So I'm just reading the question and I'm picking up the topics that, okay, these are the things which may be applicable. A building owned by Remoil Limited, the share building, will be sold to O'Clockey Limited at market value. We are to assume that market value of this building and related land will be £270,000 when it's sold. The share building was purchased by Remoil Limited from an unrelated company for £130,000 on 1st February 18. It is situated on 2 hectares of land. Remoil Limited will retain ownership of zero point 0.8 hectares of the land. We are to assume that this land retained by Remoil Limited will have a market value of £110,000 when the share building is sold. So now, this all will be happening following the acquisition. So following the acquisition, if an asset gets transferred within the group, and if capital gains group exists, please, if capital gains group exists, then the transfer is at cost plus indexation allowance. Indexation allowance is of before 31st December 17. But since the transaction is all after 31st December 17, so you will ignore indexation. Because you all know that indexation is frozen at 31st December 17. It was purchased in Feb 18, and obviously the transaction is on a later date. But for capital gains group to form, the situation should be at least 80% shares. At 60% shares, the capital gains group won't be formed. If capital gains group exists, then the transfer will be at cost. If the capital gains group do not exist, then it's a normal sale of asset. Okay. Obviously, we'll go in further detail when we'll be drafting the answer. If possible, Remoil Limited will become a member of O'Clockey Limited VAT Group registration unless it would be disadvantageous to do so. Yes, we know about VAT Group. VAT Group can be formed. For VAT Group, the ownership requirement is 50%. That's possible. Proposed write-off of a loan of £16,000 to a shareholder in O'Clockey Limited. On 1st May 2020, O'Clock Limited made a loan of £16,000 to Murray, a local businessman. Murray is one of the original shareholders in O'Clock Limited and owns 6% of the company's share capital. He is not employed by O'Clock Limited or Kilbride Limited and is not a member of Morvin's family. Murray's only source of income is an annual gross salary of 45,400. Believe me, it's very easy. You gave a loan to a shareholder in May 2020 and now you are writing it off. So when a loan given to a shareholder is written off, it becomes dividend income for that shareholder. It becomes dividend income for that shareholder. For the company, they must have paid a notional charge. That notional charge will be returned. Okay. Again, you simply go to the notes of the closed company. Okay. You go to the notes of the closed company, and there you can find the concept about giving a loan to a shareholder and when that loan gets written off. If the loan given to a shareholder is written off, it is then treated as a dividend income. Okay. Now, replacement of Morvin's company car. Morvin's company car is due to be replaced. She has sent me the relevant details of O'Clock Limited's company car scheme in order that we may advise her on the tax implications of the potential replacement. Okay, so we look at it that how this thing has to be dealt with. Now, replacement of the car. Okay, extract from an email from Morvin. As I mentioned that my company car is due to be replaced. The standard car provided by O'Clock Limited is petrol powered, has a list price of £18,000 and CO2 emission of 140 grams per kilometer. This car would give rise to an annual taxable benefit of £5,940. However, I am considering petrol powered car with a higher CO2 emission, up to 160 grams. So he's looking for a better car. These cars also have a higher list price of up to £24,000. I will make a capital contribution towards the cost of the car equal to 35% of the excess of the list price over 18,000. So he's looking for a car of up to £24,000. Okay. And any £1,000 above 18,000. Like if I go for the difference between 24,000 and 18,000, he may go for a car which is expensive by £6,000 and he will have to contribute up to 35% in it. So he can go for a maximum capital contribution of 2,100. You can use your calculator. Okay. I think it cannot be seen on the screen. So 18,000 is the company approved limit. He may go up to 24,000, but on the excess, he'll have to contribute 35%. So 35% of the excess 6,000 is 2,100, which is within the agreed capital contribution limit allowed by the tax department of £5,000. Whichever car I will use, I will continue to receive free petrol for both the business use and the private use. So there will be fuel benefit implications also. We'll look at it in detail when we will be drafting the relevant requirement. Let's look at it. Now comes the requirements for each of the part. Extract from email from your manager dated 1st June 2025. Please carry out the following work. Part A, providing advice to O'Clocky Group. Morvin is planning to continue the expansion of O'Clocky Limited Group, and I hope she will continue to use our firm to advise the group as it expands. I am conscious that one aspect of the planned expansion will lead to O'Clocky Limited establishing permanent establishments in a number of overseas countries. This is an area of taxation where our firm has very little experience. I'm also aware that Remoil Limited has been trying to use social media for marketing purposes, but so far has had little success. We may be able to assist Remoil Limited in this respect as number of our clients have achieved excellent results when marketing via social media. Explain how our previous experience or lack might affect our ability to advise the Oak-Lockey Limited Group for 5 marks. So I believe this is a simple requirement relating to ethics. It's a simple requirement relating to ethics. And if you remember, we have already done questions relating to ethics, and we had a very good discussion in our classes in relation to ethics, that how you have to deal with it. So if we just open our notes of ethics, okay, we have studied this ethics note in our classes. Just a second. Now, first of all, what he's asking is our previous experience or lack. Now, lack of experience, where we had a very little experience about dealing with the permanent establishment. So that is something what we call as the issue of competence. That is something what we call as the issue of competence. And you have already studied these fundamental principles of code of ethics. It's very important for us, being a service provider, to ensure that we have the relevant expertise, okay, attain and maintain professional knowledge and skill at the level required to ensure that the client or employing organization receive competent professional services based on current technical and professional standards and relevant legislation. Okay, now obviously it's the issue of competence. But see, having little experience do not means that we don't have the competence. Okay, we have the technical knowledge, but these are our starting few clients, so it's acceptable. Every firm has to start at some point of time. What we have to ensure is that whether we have the relevant competence, whether we have the relevant staff to deal with it or not. It's fair enough, we have little experience in this area, we'll gain it with time, we will work with our maximum care. So just having little experience do not mean that we cannot accept a client. We can accept it, but we have to ensure that we have the sufficient staff and we have the relevant technical knowledge. Yes, experience will gain with passage of time. There's no issue in it. And as far as this Remoil Limited issue is concerned, where we have other clients in the same industry, it's a matter of confidentiality. And it is one of the requirements which I've already discussed. If you remember, using knowledge obtained from one client on another clients. This is one of the routine ethical situation which is examined. If you remember, when I taught ethics, I taught some routine requirements, then I taught you important concepts to study. Okay, so now here it is the issue that we have to use the information from other clients in this Remoil Limited. So it is a matter of confidentiality. It's a matter of confidentiality that we cannot disclose the confidential information. But here what you need to understand is that general understanding and expertise gained are not restricted due to confidentiality matters. Okay. Like for example, if we have dealt some clients in some industry, so it's not like that we cannot use that experience. We have to ensure that we don't give up the confidential data. Otherwise, the knowledge and the experience which we gained is our intellectual asset. We can use that. There is no issue in it. Otherwise, if we will start restricting like that, then no one can use the experience which they have gained in past. Okay. So here we just need to develop a very simple answer in which we have to provide advice. So basically, we will be discussing that in one area we have lack of expertise. In one area we have lack of expertise, and in another area we have experience from our previous clients. Okay, so we have to draft answer in this manner. Let's look at it, that how we have to deal with it. Now we'll go to word processor. Now this is our requirement, providing advice to Oak-Lockey Group. The question name is Oak-Lockey Group. This is our first requirement. Okay, just a second. Now you must be thinking that, sir, normally in question number 1, we make a memorandum or notes of the meeting, because in question number 1, there are professional skill marks of communication. So why didn't you make the format of the email or something like that? See, in this part, he didn't ask. He just directly asked that please carry out the following work. But when you will go for part B, here we have to prepare the notes for the meeting. So then we will prepare a format. It's very important that you read the requirements. Okay. So this is a simple requirement in relation to ethics. And now here there are two things. One is I'm conscious that one aspect of the planned expansion will lead to Auckland Limited establishing permanent establishment in number of overseas countries. So this is an area where we lack experience. Okay. Lack of experience in advising Auckland Limited for its overseas expansions. This is one issue. And another is using the knowledge for Remoil Limited. So now for this point, we have to think from the ethical perspective. Our firm has to ensure that whatever services it is providing to its clients, it must have relevant competence and skills to perform those services. Okay. Planned expansion of Auckland Limited to other countries or to overseas by opening permanent establishments creates a concern for our firm in relation to competence, as our firm has limited expertise or experience in this area. It is a requirement of ethical code that a firm should only provide those services for which it has relevant skills and expertise. Okay, see, just grab the answer in a normal manner, no stress. There's an issue of lack of experience, you referred the ethical code point of competence. But now you have to go in detail. First, we highlighted that, okay, this is an issue. But now you will argue that just having lack of experience do not stop you in itself. If you have the relevant knowledge, if your staff is trained, fair enough, go for it. Experience is not the only limiting factor. However, it is to note that just having limited experience in itself do not stop a firm from accepting the work. Okay, if our firm has relevant knowledge and trained staff to deal with the situations of foreign permanent establishment, then despite of having limited experience, they can provide the service. They have to ensure that while providing services, they perform their work with diligence. Okay, you have to perform the work with due diligence. Let me repeat it again. We have little experience. Okay, this is an issue of competence. But just limited experience is not the stopping factor. Is your staff trained? Are they educated? They have the knowledge of the relevant rules? Okay, go for it. Because for every firm, there is some starting point. If everyone will think in that way that, okay, we have a limited experience. So how will you gain the experience? You gain experience with passage of time. You just need to ensure that, okay, you have the competent guys on. Another issue is that using the knowledge of other clients while assisting Remoil Limited. Okay, we may be able to assist Remoil Limited. Assistance of Remoil Limited. Okay, our firm needs to consider matters in relation to confidentiality while deciding to assist Remoil Limited. As in that assistance, our firm will have to use its knowledge gained from its previous clients. Okay. Ethical code requirement of confidentiality restricts a service provider to disclose clients' confidential information while performing its services, and also after the engagement is completed. Okay, our firm cannot disclose confidential information of its previous clients to Remoil Limited. However, it is to note that general understanding and expertise gained can be used to assist future clients. Okay, this assistance should be in such a way that confidential data about other clients is not disclosed. Now, what do you mean by this? Like, for example, if I'm guiding you about the social media, so I'll say that, okay, this is how the Facebook marketing is done, this is how you create audience, this is how you use the tools. Okay, fair enough. There is no issue in it. The issue arises when I say that, okay, that a company has created this audience, you also create the same audience. Then that's disclosing confidential data. Confidential data, I tell you about their pricing. That, okay, this is how they develop the price. I give you the customer data, then there's an issue. Otherwise, general understanding using the tools, it's no one's asset. Okay, we gain the understanding while providing you the services. We can use it in other clients also. This is what we call as the competitive edge. Okay. So first matter was in relation to lack of experience while advising O'Clocky Limited for overseas expansion because we had limited experience, but limited experience in itself do not stop us. Limited experience in itself do not stop us from providing the service. As far as we have the technical knowledge and we believe that we can perform the service. Then the second issue was that when we talked about Remoil Limited, so for assisting Remoil Limited, we have gained understanding from our previous clients. So it's a matter of confidentiality, but as far as we don't breach confidentiality, we don't disclose the internal data, there is no issue in it. Okay, now let's move forward. Part B, meeting to discuss the O'Clocky Limited's group plan. Please prepare notes for use in a meeting with Morwin and the finance director of O'Clocky Limited. You should set out the notes in a manner which will make it easy for us to refer to them during the meeting. Okay, so now we have to prepare the meeting notes. For the O'Clocky Limited. Our discussion will cover the following matters. So now this is part B, meeting to discuss O'Clocky Limited's group plan. I want you all to listen to me carefully. Control C to copy, and I pasted here, Control V. Okay. Now, so we have to prepare the notes for the meeting. Okay, please prepare notes for us to use in the meeting. So we are preparing notes for the meeting. Okay, to the client files. It will be put in the client files from, this is the routine format which we use. So we have been sent by the email by our manager. So obviously we'll be a tax supervisor or a tax senior. Okay, from tax supervisor, client, O'Clocky Limited Group. Okay, subject, corporate tax affairs, date. This is a simple format for notes for the meeting. Date is 1st June 2025. The date in the question, okay? Don't write the today's date. So date 1st June 25 to the client files from tax supervisor, because we were sent an email by the manager, so we'll be either supervisor or senior. Client is O'Clocky Limited Group. We are talking about the corporate tax affairs, date 1st June 25. And here you go. This is part one. Planned acquisition of O'Clocky Limited shares in Remoil Limited. This is the part one which we will be dealing with. Now, let's read it. Your notes in respect of both 1 and 2 below should cover what it should cover: the situation where O'Clocky Limited acquires 60% of the share capital of Remoil Limited, and any different implications which would arise if instead O'Clocky Limited were to acquire 80% of the share capital. See, if you acquire 60%, you will get the controlling shares, but it will not lead to formation of a capital gains group or a 75% group. Because for capital gains group or 75% group, you need minimum 75% share ownership. You need minimum 75% share ownership if you need a capital gains group or a 75% group. Okay, were to acquire 80% of the share capital. So yes, different thing will be that a group will be formed of capital gains group and 75%. Number one, corporation tax. There has not been a major change in the nature or conduct of the trade of Remoil Limited, and it is not anticipated that this will occur in the future. Like the target market or things like that are not changing. But if you remember, we already referred that there will be revival of trade. Morven will reestablish and grow because currently the trade has fallen to very low level. So that is what we call as revival. But in that revival, he's saying that he won't change the target market or things like that. But still, the revival of trade is also considered as major change in activity. If you remember, I showed you also loss relief restriction. Okay, what does it include? Change in primary activity, change in target market, or revival of trade. So Morven will revive the trade. However, the fall in turnover may result in the scale of its activities being regarded as having been small or negligible. With this in mind, explain how trading losses and capital losses carried forward by Remoil Limited as at 31st March 25 can be relieved against future profits of Remoil Limited and any restrictions which may apply. You should not consider the possibility of the losses being relieved against the profits of any other member of O'Clocky Group. Here we have to think about that Remoil Limited using the loss against its own future profits. It is using the loss against its own future profits. So the loss relief restriction will get applicable, and you cannot use your trading loss if there is change in activity and change in ownership. Your losses get restricted on the date of change in ownership. As far as the capital losses are concerned, it will get applicable to the rules of pre-entry capital losses, where you can only use it against pre-entry gains or the assets which were acquired before joining the group, or the assets which were acquired after joining group but were acquired for trading purposes. We will look at that, the topic of pre-entry losses, pre-entry capital losses. Okay, pre-entry capital losses has to be used against pre-entry gains. If the gain is post-entry, the asset should be old asset, or if the asset is purchased from the third party for the trade purpose. Okay, so we'll look at it when we'll be drafting the answer. Explain with supporting calculations corporate tax implications of the planned sale of share building. Okay, so for share building, if it is 60% ownership, or share building, if it is 60% ownership, in that case, it will be a normal sale because capital gains group is not formed. But if it is 80% ownership, then capital gains group will be formed, and in that case, the transfer will be at cost. Okay, indexation allowance is being ignored. The reason being is that this transaction is done before this transaction is done after 31st December 17, and on 31st December 2017, the indexation factor has been frozen. All of this was done after 31st December 17. If you remember, The purchase was also in February 18, the purchase of asset, and this all transaction is being done in 2025. So that's all after December 17. So now the first part is in relation to corporate tax. Let's start drafting the answer in relation to it. We'll first break the answer in small parts and we'll start dealing with it. Okay, let's look at it. Okay, so let's start with the first part of this requirement. Explain how the trading loss and capital loss forward by Remoil Limited as at 31st March 2025 can be relieved against the future profits of Remoil Limited and any restrictions which may apply. So first of all, we will be talking about carried forward trading loss. Okay, first of all, we will discuss about this and then we will discuss about the carried forward capital loss and so on we'll move. Now, if you look at the carried forward trading loss of the year ended 31st March 2025, the problem here is that the change in ownership of Remoil Limited will happen on 31st of March 2026. In either case, either being 60% or 80%, in both of the situations, there will be major change in ownership because more than 50% shares are being transferred. And along with that, since Marvin intends to reestablish and grow the trade of Remoil Limited, it will be regarded as revival of trade, which will then be considered as major change in activity. If you remember the rules of loss relief restriction, okay, if you remember the loss relief restriction rules, if there is major change in ownership along with major change in activity within 3 years before or up to 5 years after, then the loss gets restricted. Loss cannot be carried forward nor carried back beyond the change in ownership date. Okay, so we have to discuss about the carried forward loss of Remoil Limited. Okay, Remoil Limited's ownership will be majorly changed on 31st March 2026 when Aucklocky Company will acquire more than 50% shares of it in both of the proposals, which involve either acquisition of 60% shares or 80% shares. Okay, ownership is considered as majorly changed if more than 50% shares of a company are sold. Okay, so first of all, there will be major change in ownership. Further, its activity will also be considered as majorly changed because Remoil Limited's current turnover before acquisition has fallen to negligible values, and Marvin, who is the director of Aucklocky Limited, and Marvin intends to reestablish and grow this Remoil Limited after its acquisition. Okay, it will be considered as revival of trade, which is regarded as major change in activity. Okay, as both of these events of major change in ownership and major change in activity are happening together. Therefore, loss relief restriction will be applicable on brought forward trading losses of Remoil Limited. Remoil Limited. Okay, loss relief restriction will be applicable on it. Due to loss relief restriction, trading losses will not move beyond the change in ownership date. This means that trading losses of before 31st March 2026, which is change in ownership date, will not be carried forward to a period after 31st March 2026. Further, any trading loss arising after 31st March 2026 will not be eligible for carryback to periods before 31st March 2026. This means that Remoil Limited will only be able to use its brought forward trading loss of 31st March 2025 in year of 31st March 2026 only, as loss will not be eligible for carry forward beyond this date. Okay, Remoil Limited can offset maximum of its trading loss of 31st March 2025 against total income of 31st March 2026. Any remaining loss will get wasted. So please repeat it again. Obviously, I repeat it again, you all know. First of all, we are talking about the carried forward trading loss. See, the problem is that Remoil Limited has some brought forward trading losses from 31st March 2025. Okay, they have these some brought forward trading losses, old losses of 31st March 25. Now, since there is change in ownership happening on 31st March 26, when Auck Limited, when Auck Limited will acquire more than 50% of its shares, either being 60% or 80%, both are more than 50% transfer. So ownership is considered as majorly changed. Further, its activities will also be considered as majorly changed. Why? Because the current turnover has fallen to negligible value, and Marvin, who is the director of Auck is planning to reestablish and grow Remoil trade. So that is considered as revival, which is also called as major change in activity. Okay, as both of these events, major change in ownership and major change in activity, are happening together. Even if it happens in next 5 years, then also the restriction applies. Therefore, loss relief restriction will be applicable on brought forward trading losses of Remoil Limited. Due to loss relief restriction, trading loss will not move beyond the change in ownership date. This means that trading losses of before 31st March 26, 31st March 26 is the change in ownership date, will not be carried forward to a period after 31st March 26, and any losses which arose after 31st March 26 will not be able to carry back. Consider it as a wall. Old losses cannot move forward and new losses cannot go back. Okay. So now what maximum Remoil can do is that it has some old losses of 2026. It can use in 20 after losses of 25. It can use them maximum in 26 because 31st March 26 is the barrier. You can use in the entire year of till 31st March 26, but not beyond that. See, the restriction creates a wall on change in ownership date. The change in ownership date is 31st March 26, when these shares will be acquired. So that's the wall. Anything beyond that, you can, before that, you can offset. You cannot go after this date. You have a loss of 25, okay, offset till 31st March 26. You cannot move forward. Okay, so Remoil Limited can offset maximum of its trading loss of 31st March 25 against total income of 26. Any remaining losses will get wasted because you cannot go forward. You cannot go beyond 31st March 26 because that's the barrier. Okay, now if I talk about carried forward capital loss. Okay, see, this barrier is only for the trading loss. This barrier is only for the trading loss. It's not for the capital losses. Now, when we talk about the capital losses, which it has, like, if you can look at it, here it was given that it has a capital loss brought forward of 47,000 pounds. Now, for capital loss, you can offset it against your future gains. Okay. But if a capital gains group is formed, then the restrictions of pre-entry capital loss will get applicable. Okay. Now, Remoil Limited can use its brought forward capital loss of 47,000 pounds against its future gains. There will be no restriction on it if O'Clockey Limited acquires 60% shares of Remoil Limited. As in that case, capital gains group will not be formed. However, if 80% shares are acquired by O'Clockey Limited of Remoil Limited, then capital gains group will be formed as condition of 75% direct ownership will be satisfied. It is our direct subsidiary, so there is no need to look at the indirect ownership requirement of 50%. The first requirement to satisfy is 75% direct ownership. If capital gains group is formed, then restrictions of pre-entry capital loss will be applicable. Okay, if the capital gains group get formed, then obviously the restriction of pre-entry capital losses become applicable. Now, what are the restrictions of pre-entry capital loss? If you look at it, okay, as per the restrictions of pre-entry capital losses, Remoil Limited will only be able to offset its capital loss of 47,000 pounds against either of the following gains. Now, what are these following gains? Number one, pre-entry capital gains, that is, gains which were realized before joining capital gains group on 31st March 2026. Any gains which were realized before joining the group. If capital gain has realized after joining capital gains group, then the asset on which that capital gain has arisen should have been purchased by Remoil Limited before joining capital gains group with O'Clockey Limited on 31st March 2026. Number third, if capital gain has been realized after joining capital gains group and asset was also purchased after joining capital gains group, then that asset should not have been purchased by a group company, that is O'Clockey Limited, and it should have been purchased for trade purpose, like for your business purpose. Let me repeat it again. See, these are the rules of the pre-entry capital losses which you have already studied. See, if Remoil Limited's 60% shares are acquired by O'Clockey Limited, then there is no capital gains group. Remoil Limited can use its loss in normal manner against its future gains. But if 80% shares are acquired, then capital gains group will be formed. And if capital gains group is formed, then there are certain restrictions. Because the reason of these restrictions is that once the capital gains group is formed, the group companies start to give you their assets. So in that way, you can offset the pre-entry losses against the group assets. So the objective is to restrict that. You can offset the pre-entry loss against your pre-entry gains only, the gains before 31st March 26. If the gain has been realized, if the capital gain has been realized, or if the capital gain is realized after joining capital gains group, then that asset on which the gain is realized, you have a loss, you want to offset it against a gain. So the gain should be on an asset which was purchased before joining group. Like it shouldn't be a group asset. And if the asset is purchased after joining group, it shouldn't be purchased from a group company. It should have been purchased for your trade purpose from outside the group. So if you look at this requirement till now, I particularly believe that it's not difficult. It's some very basic rules. It was a clear indication that you have to think about trading loss relief restriction when you referred that the trade has been fallen to a low level to negligible level. Here, then in the scenario, it was written that he will reestablish the trade and make it grow. So it was a clear indication about revival. So you refer the loss relief restriction. As far as the capital loss is concerned, if the capital gains group is formed, then pre-entry capital loss relief restrictions become applicable. That is formed when there is 80% share transfer. But if it's 60%, then there is no such restriction. Then, okay, so you should not consider the possibility of the losses being relieved against other members of O'Clocky group. So, okay, we haven't referred that. Okay, we have just referred that how he can use the loss against his own gains also. We haven't referred the reliefs of transferring to the group. The entire debate is that how Remol has to use it against its own income and gains. Now explain with supporting calculation the corporation tax implications of the planned sale of the share building. Okay, so now if you look at the scenario, there is discussion about this share building situation. Okay, so first of all, we discussed about the loss relief restriction for the trading loss. Then we discussed about the relief. If it's 60% share acquisition, then there is no capital gains group. You can relieve the loss against your own future gains. But if 80% shares are acquired, then there will be capital gains group and the restrictions of capital gains group will be applicable. Okay. Now, as a result, you have to offset the loss against your own gains. Either those gains should be pre-entry gains. If the gain is realized after joining group, then the asset should have been purchased before joining group. Okay. And if the gain is realized after joining group and the asset is also new, then it should not have been purchased from a group company. Okay. It should not have been purchased from any of the group company. And here in this case, obviously, the group companies O'Clocky Limited or any of the O'Clocky Limited's other group members. So it should not have been purchased from a group companies. Currently, since there's only O'Clocky Limited, so you can refer the name of O'Clocky Limited, or you can just state that it should not have been purchased from a group company, it should have been purchased from a third party, and it should have been purchased for their trade purpose. Obviously, all of these rules of pre-entry capital losses, you have studied them. Okay, pre-entry capital loss. Okay, here you go. These are the restrictions of your pre-entry capital losses, that how you have to use them. You have to use your against your own pre-entry gain. If the gain is realized against after joining the group, if it's a post-entry gain, the asset should be old. And if the asset is new, it should have been purchased from third party. It shouldn't have been purchased from any of the group company. Okay, so I hope that makes it clear. Now we are talking about the tax implications for the planned sale of the share building. Okay, let's look at it. Now, if I talk about the planned sale of the share building, here the important thing is that if 60% shares are acquired, then in that case there is no capital gains group and then it's a normal disposal. But if 80% shares are acquired, then it's a transfer within capital gains group. And in that case, the transfer will be at cost. If ACCA Limited will acquire 60% shares of Remoil Limited, then Capital Gains Group will not be formed as direct holding is less than 75%. In this case, sale of share building will be a normal disposal made by Remoil Limited to Aucklocky Limited. Okay, it will be a normal disposal made. It will be a normal disposal made. Okay, if you are acquiring 60% of the shares, then there is no capital gains group. And in that case, it will be a normal disposal. So if I talk it as a normal disposal, the disposal proceed is £270. Okay, the cost was £130,000, but it is a situation like part disposal because Remoil Limited is retaining some part with itself also. So let's look at it. Now you can do this calculation in spreadsheet also, but I prefer doing on word processor using this table format so that the entire answer is solved on a single screen. But if someone want to use a spreadsheet, that's completely acceptable. Disposal proceed is £270,000. Cost of disposed part, the total cost was £130,000. The total cost was £130,000. Remoil Limited is retaining 0.8 hectare, a portion, and that has a value of 110. So total cost multiplied by disposal proceed, £270,000 divided by disposal proceed plus market value of remaining. I hope you all remember the rules of part disposal. I hope you all remember the rules of part disposal. Total cost multiplied by disposal proceed divided by disposal proceed plus market value of remaining. Okay, so the cost of disposed part will be 130,000 multiplied by 270,000 is the disposal proceed divided by 270,000 plus 110,000. So the cost of disposed part is 92,368. So that gives us the chargeable gain, 270,000 minus 92,368. So your chargeable gain will be 177,632 pounds. Okay. See, in this case, we are just solving it in a normal manner. In this case, we are just solving it in a normal manner. Are you getting it? Okay. Now it has a capital loss brought forward. Remoil Limited, I hope you all remember that capital loss brought forward is 47,000. So the taxable gain will be 130,632. On this capital gain, Remoil Limited will have to pay its corporation tax. Okay, so if you look at it in this part, it's just solved like a normal disposal. It is just solved like a normal disposal of asset. However, if Aucklocky Limited will acquire 80% shares of Remoil Limited, then in that case, Capital Gains Group will be formed as more than 75% direct ownership is held. In case of Capital Gains Group, asset will be transferred at its cost from Remoil Limited to Aucklocky Limited. Okay, cost of the asset transferred will be 92,368. Okay, let me repeat it again. I believe that it's not difficult. It was a very simple comment to write. Okay, what we are saying is that if we acquire 60% of the shares, then there is no capital gains group. It will be considered as a normal sale. Disposal proceed is 270,000. Okay, this will become cost for O'Clocky Limited for its future disposal. Okay, because asset will be transferred at its market value. Remol Limited is selling it for 270. This 270 will become a cost for O'Clocky. For the acquiring, obviously, it will be transferred at its market value. Cost of disposed part, it's just a simple adjustment of part disposal. You get a chargeable gain. Capital loss brought forward was 47,000. You all know that Remoil Limited has a loss of 47,000 to carry forward. Okay, and in 60% ownership there are no restrictions or something like that. You use it in a simple manner, you get a taxable gain of 130632. So I believe that it's something which is very much easy, and then there is no point that a student may get confused or any possible confusion which may arise. Okay, and then if 80% shares are acquired, then a simple capital gains group will be formed and the asset will be transferred at its cost. So, a 12 marks requirement is done, obviously a big one. Creating loss restriction, comment on the brought forward capital loss, and the sale of share building. I believe that I've repeated a lot, and there is no reason that you might have any confusion. Now let's move forward. Let's look at the other thing, which is in relation to value added tax. We are done with this corporation tax thing. Now we are looking at the value added tax, which is the next part of 6 marks. Let's look at it. I want you all to listen to me carefully. Let's read that what he's asking from us in this part. Explain why Remoil Limited will be able to become a member of the O'Clocky Limited's VAT group, and any potential disadvantage of this course of action, and whether or not Remoil Limited will be able to continue for VAT under flat rate scheme. And then explain whether or not Remoil Limited will be required to charge VAT on sale of the share building to O'Clocky Limited. A requirement for 6 marks. Let's look at it. Okay, so let's look at it. Explain why Remoil Limited will be able to become a member of the O'Clocky Limited VAT group, and any potential disadvantage of this course of action, and whether or not Remoil Limited will be able to continue to account for the VAT under the flat rate scheme. See, for the VAT group, the requirement is more than 50% share ownership. So that is satisfied. And it's not an issue whether you own 60% or 80%, because in both of the situations, you own more than 50% of the shares. Okay. So yes, Remoil Limited can join the VAT group, and it has its operations in UK also. Now, what are the potential disadvantages? When a VAT group is formed, the entire group will have to make a single VAT return, and if there is any error or any mistake in the VAT return, the whole group will be jointly and severally liable. Okay, if you remember. And accordingly, there are issues relating to de minimis test also, that if any of the company is making a lot of exempt supplies, then it may lead to a failure of the VAT group de minimis test situations. Okay, I hope you all remember these rules, and will be able to continue under the flat rate scheme. The answer is no. Once you join a VAT group, you have to leave all of the accounting schemes like annual accounting scheme, cash accounting scheme, or flat rate scheme. And whether or not Remoil Limited will be required to charge VAT on sale of the share building. If the VAT group is formed, then there is no need to charge VAT, as it will be an intra-group transaction. But if it is not part of a VAT group, then in that case, it will need to be considered that whether this building, share building, is a standard rated category if the election of up to tax is made. Otherwise, it will be an exempt category. So first of all, explain why Remoil Limited will be able to become a member of the O'Clocky Limited VAT group. Remoil Limited will be able to join O'Clocky Limited's VAT group has more than 50% shares of Remoil Limited will be acquired by ACCA Lockheed Limited. This will be satisfied. This will be satisfied in both investment options of acquiring either 60% shares or 80% shares. Okay, in that group, Remoil Limited, Aucklocky Limited, and there was one more company, if you remember, there was one more company with Aucklocky Limited, Kilbride Limited. And Kilbride Limited will be the members. Okay. It is to note that it is not necessary to include Remoil Limited in that group. And some of the companies can be excluded from that group registration also. Okay, Remoil Limited is eligible for that group, but including it in group registration or not can be decided by ACCA Lockheed Limited. Let me repeat it again. Remoil Limited is eligible to join VAT group, but it's not necessary that if every company is eligible, you include them in VAT group also, because sometimes one of the companies making a lot of exempt supplies, and it may lead to failure of our partial exemption rule de minimis test. If you remember the value-added indexes, or maybe do not have very good bookkeeping, so as a result, the whole group may face penalties if there are any mistakes. Okay. So first of all, we said that, okay, it is eligible to join VAT group either at being 60% or 80%, because that's more than 50% share ownership. But it's not necessary to include it in VAT group. That's completely need to be decided by the parent company. Potential disadvantage of including Remoil Limited in VAT group is that if Remoil Limited will make any mistakes in its VAT return, then it may misstate the group VAT return, and as a result, penalties on group may become applicable on joint and several basis. Like all of the group companies become liable if any of the group company makes error. Like if we include Remoil Limited, then maybe due to its mistakes, its errors, whole group may start to suffer. So if you look at it, explain why Remoil Limited will be able to become a member. Yes, because more than 50% share ownership is held. Potential disadvantage, single return, so risk of mistake and penalty. Whether or not Remoil Limited will be able to continue to account for VAT under flat rate scheme, the answer is no. If Remoil Limited will join VAT group, then it will not be able to continue in flat rate scheme. Okay, no special accounting schemes of VAT are available in VAT group situations. Okay. Then he's asking that whether or not Remoil Limited will be required to charge VAT on sale of share building to Aucklocky Limited or not. Okay. If Remoil Limited will become part of VAT group with Aucklocky Limited, then no VAT will be charged on sale of building by Remoil Limited to Aucklocky Limited, as in that case it will be an intra-group transaction. Okay. However, if Remoil Limited is not part of that group, then VAT implications on sale of share building to Aucklocky Limited will become relevant. Okay, as share building is more than 3 years old and it is a commercial building, therefore, VAT implications will depend on a fact that whether opt-to-tax election is made or not. If election of opt-to-tax is done on it, then VAT on sale will be charged. If opt-to-tax election is not done, then it will be considered as an exempt sale and no VAT on sale will arise. Let me repeat it again. I believe that these were very easy 6 marks. First of all, we had to comment that why it is eligible to join VAT group. A simple reason is that more than 50% ownership exists, and for VAT group, the only condition is more than 50% ownership such that you have operations in UK. So yes, that is satisfied. Then it is to know that it is not necessary to include. It's completely the choice of the parent company that whether it want to include or not. Then the potential disadvantage is that since a single return has to be filed, so if any of the group company makes any mistake, the whole group will become liable. Flat rate scheme is not available. Okay, when you enter a group, you have to go with the normal VAT only. Then no VAT on sale of the building if we are part of a VAT group, because it will be an intra-group transaction within the VAT group. But if it is not part of a VAT group, then we need to think about the VAT implications. This share building was of 2019, if you believe, of 2018. So it's more than 3 years old now. We are currently in 25. So if opt-to-tax election is done, then it's standard rated. Otherwise, it will be in exempt category. Okay, so I believe very easy 6 marks capture here. Now, let's move towards the next requirement. Proposed write-off of a loan to a shareholder for 8 marks. Okay, it's our second last requirement. So let's look at it. I want you all to listen to me carefully. Now, what he's asking here. Explain with supporting calculation the tax implications for both Aucklocky Limited and Moray of the proposed write-off of the loan for 8 marks. I believe again it's a very easy requirement. The reason being is that it's a simple situation that a loan is being written off of a shareholder of a closed company, because Aucklocky Limited is a closed company. It's more than 50% shares were owned by Morwen. Okay, 5 or fewer shareholder owning more than 50% shares, it's a closed company. And if in closed company the loan is written off, then in that case it will become a dividend income for the shareholder, and for the company the good news is that it will get back the notional charge which it has paid on that loan. Okay, so now let's read it and then develop the answer in relation to it. Okay, so on 1st May 2020, Aucklocky Limited made a loan of £16,000 to Murray, a local businessman. Murray is one of the original shareholders in Aucklocky Limited, owns 6% of the share capital. He's not employed by Aucklocky Limited or Kilbride Limited and is not a member of Morwen's family. Murray's only source of income is an annual gross salary of £45,400. Okay, first of all, what we have to argue is that Aucklocky Limited is a closed company as it is controlled, is a closed company as it is controlled by a single shareholder. What's his name? Morwen. By a single shareholder, Morwen, who owns 55% of its shares. A company is considered as closed company if it is controlled by 5 or fewer shareholders. Control is assumed on more than 50% share ownership. So first of all, we have argued that Aucklocky Limited is a closed company. Okay. As Aucklocky Limited is a closed company, it must have paid a notional tax when it gave loan to Murray, in tax year May 2020, which was the tax year of 2021, to Murray of £16,000. Let me copy the pound sign. Just listen to me with patience and you will be able to understand it. Of £16,000. Okay. Now, if Aucklocky Limited will write off this loan, it will be able to recover the notional tax paid of £16,000 multiplied by 33.75%. Okay, if you don't remember the rules of closed company, you need to go to the summary notes and refer that again. Okay, like if you go to the summary notes and you simply write closed company, you can find the rules relating to giving a loan to a shareholder. That when you give a loan to a shareholder, you have to pay 33.75%. So when you will write off this loan, that deposit notional tax which you have paid will be returned to the company. Okay, this notional tax will be returned 9 months after the end of the tax year in which loan is repaid. Okay, the year in which you repay the loan, after that you can get back the notional tax which was paid. Okay, is repaid or is written off. Since here it is the situation of write-off, so you will refer that either getting repaid or written off. In both of the situation, the tax department will return the notional tax to the company. Let me repeat it again. First of all, we proved that Aucklocky Limited is a closed company as it is controlled by a single shareholder. Then we said that when Aucklocky Limited gave loan to Murray, at that time they must have paid a notional tax to the tax department, which is 33.75%. As Aucklocky Limited is a closed company, it must have paid a notional tax when it gave loan to Murray of £16,000. If Aucklocky Limited will write off this loan, it will be able to recover the notional tax of £16,000 multiplied by 33.75%, £5,400. It will get back that amount. The notional tax will be returned 9 months after the end of the year in which the loan is written off. So the company can get back whatever notional tax or the deposit it paid to the tax department on the loan when it gave it to the shareholder. Okay, I hope that you are understanding it. First, we proved that it's a closed company. Then we said that whatever notional tax was paid when loan was given, notional tax will be returned. Okay, from the perspective of shareholder, that is Murray, it will become dividend income for him as he is a shareholder of this company, Aucklocky Limited. Okay, Aucklocky Limited is a closed company, and write-off of a loan given to shareholder is considered as dividend income. Okay, on this dividend income, Murray will have to pay income tax. Which will be how much? On first £500, you all know that dividend is taxed at 0%, so that will give us £0. And then we need to look at his basic rate band. He already earns a gross salary of £45,400. So we need to split between the basic rate band and a higher rate band. So available basic rate band, 37,700 is your basic rate band. He already have a gross salary of 45,400. So 45,400 minus the personal allowance 12570, and then the basic rate band will also be used by this 500 pounds. See, I believe that at this level, you know these basic income tax calculation at a very good level. Your basic rate band is 37,700. Your existing gross salary is 45,400. You will adjust the personal allowance and this 0% band. So 45,400 minus 12570, 32,830 is used against your salary of the basic rate band. So 37,700 is your basic rate band. You have 4870 remaining. You will adjust 500 more. So you get 4370. This will be taxed at 8.75%. So this gives us 382 pounds, and remaining dividend income will be how much? It's 16,000 pounds which is being written off. From this 16,000 pounds, 500 pounds is taxed at 0%, 4370 is taxed in basic rate band. So 16,000 minus 500 minus 4370, so that is 11,130, and in higher rate band it's 33.75%, so that gives us 3756 pounds. Okay, total income tax on dividend will be plus 382, so it's 4138 pounds. Let me repeat it again. See, we have to discuss about the implications due to write off this loan. So first of all, we prove that Aucklocky Limited is a closed company. It is controlled by single shareholder Morven, who owns 55% shares. And for control, it's more than 50% ownership by 5 or fewer shareholders. Obviously, single shareholder is less than 5. As Aucklocky Limited is a closed company, it must have paid a notional tax when it gave loan to Moray of 16,000 pounds. If Aucklocky Limited will write off this loan, it will be able to recover the notional tax paid of 16,000 pounds multiplied by 33.75%. This notional tax will be returned 9 months after the accounting year end of the period or of the year in which the loan is written off. See, once the accounting period in which the loan is written off or repaid, you get the refund after the 9 months, because you all know that the corporation tax normal payment dates are also 9 months. So whatever you pay or whatever refund you get, it's 9 months. Okay. From the perspective of shareholder, that is Moray. See, Morven makes it a closed company, but this loan was given to other shareholder Moray. But that do not creates any difference since it's a closed company. So the implications will remain for all of the shareholders. It will become dividend income for him as he's a shareholder of Aucklocky Limited. Aucklocky Limited is a closed company, and write-off of a loan given to shareholder is considered as dividend income. On this dividend income, Moray will have to pay income tax, and this will be the income tax. Lastly, if you want to add a comment, you can add it also. As write-off of a loan is considered as dividend income, therefore it will not be an allowed expense for Aucklocky Limited. Okay, since it is considered as dividend paid, since it's not to a shareholder, it's a dividend income for the shareholder who is not an employee, so dividend is not an allowed expense for the company. So proposed write-off, you prove that okay, it's a closed company. You said that a notional tax must have been paid at the time the loan was given. You discussed that when the loan will be written off, the notional tax will be recovered by the company. From the perspective of shareholder, it will become a dividend income, and on that dividend income tax will be arising. Okay. Again, I would say very easy 8 marks here to gain. Now comes the last requirement. Meeting to discuss Morven's replacement company car. Okay. Now we are out from the Aucklocky Limited implications. Now we are talking about the Morven, his replacement car issue. See, till now, I believe that this question has been very easy. Like if you look at this question till now, first requirements were in relation to ethics, which were pretty much straightforward. Then in relation to brought forward trading loss, loss relief restriction impact, capital loss, pre-entry loss matters. Then this simple sale of share building. If the group exists, the capital gains group, then it is transferred at cost. Otherwise, it will be a normal sale. VAT implications, then write-off of a loan in case of closed company situation. Now comes this last requirement. Till now, I believe that this question was a very scoring one. Please prepare notes for us in a meeting with Marvin. So now new notes to the meetings have to be created. Okay, the old notes are done. So if you want, you can add thank you here just as an indication that the previous note of the meeting is done. We have to prepare new notes for the meeting. So it's just a same format, notes for the meeting. Okay, to the client files from tax senior or supervisor, whatever you write. Okay, client. Now we are doing it for Marvin. Subject, Marvin's replacement company car, replacement of company car, date that was written here at the start. It's 1st June 2025. So it's just the same format. Okay, notes for the meeting. Now let's see that what he is asking. Okay, now please prepare notes for us to use in a meeting with Marvin. Again, you should set out the notes in a manner which will make it easy for us to refer to them during the meeting. I can confirm that taxable benefit figure in respect of a standard car would be 5940 pounds. Explain the amount by which Marvin's annual taxable benefit in respect of the car and petrol would increase depending on the list price and CO2 emission of the car she chooses. 9 months. Now, if you remember this matter of replacement car, what Marvin was planning is that her change of car was due from the company. So she was planning to go for an expensive car. Expensive car with a greater CO2 also. Okay. Let's read this again also. As I mentioned, my company car is due to be replaced. The standard car provided by Hawk Limited is petrol powered, has a list price of 18,000 pounds and CO2 of 140 grams per kilometer. This car would give rise to an annual taxable benefit of 5940. This was the existing benefit. However, I am considering a petrol powered car with a higher CO2 emission up to 160 grams. From 140 grams, he is planning to go for 160 grams. So greater CO2 emission means greater car benefit and greater fuel benefit. Because for car benefit and fuel benefit both, you have to look at the CO2 emission. These cars also have a higher list price, up to maximum 24,000. So from 18,000, he is going for 24,000. I would make a capital contribution towards the cost of car equal to 35% of the excess of the list price over 18,000. Whichever car I will choose, I will continue to receive free petrol. Now we don't know exactly that what will be the value of car and what will be the CO2 emission. Because in both of the situation, he said that it can go up to 160 gram and up to 24,000. So we have to draft an answer in such a way that in a meeting it can be easily conveyed to Marvin that okay, what will be the implications of this change in car. Okay, let's look at it. Okay, so now if we look at it, there are two possible situations. One is the situation if the list price of a car increases from 18,000 and it can go up to 24,000 pounds. One is the possible increase in list price of the car. And another matter is possible increase in CO2 emission from 140 grams to 160 grams per kilometer. Okay, so let's look at each of the situation one by one. So increase in list price of the car. Now, I want you all to listen to me carefully while we discuss it. Current list price of car provided to Morven is 18,000 pounds. The current list price of the car is 18,000 pounds. Is 18,000 pounds, and this car has a CO2 emission of 140 grams per kilometer. Okay, CO2 emission percentage for car benefit will be how much? Now, if you look at the text tables, 140 grams per kilometer, see the text tables are here on the bottom at help/text tables. You click on that, and here you go, the text tables. Okay, so you look at the car benefit CO2 emissions. For 55 grams, it's 16%. And then for every 5 grams extra, it increases by 1. So how much will it be? Car benefit percentage will be 16% till 55 grams, and then additional 1% for every 5 grams extra. Okay, it will be 140 grams minus 55. So it will be 85 divided by 5. I will repeat the things again also. So that is 17% plus 16%, which is for 55 grams. So that brings the total to 33%. Let me repeat it again. Current list price of the car provided to Morven is 18,000 pounds. And this car has a CO2 emission of 140 grams per kilometer. CO2 emission percentage for car benefit will be 16% till 55 grams, and then additional 1% for every 5 grams extra. So it will be 140 grams minus 55 grams. So that gives us 85 grams divided by 5. For every 5 grams extra, it increases by 1. So it increases by 17%. 16% was the base percentage. So that brings total to 33. I hope you all know how to do this car benefit working. Above 55 grams, 55 to 140, 85 is extra. For every 5 grams extra, 1 will increase. So increases of 17. The base percentage for 55 gram is 16%. So that brings total to 33%. Now, if list price of car goes above 18,000 pounds, Morven will pay 35% of that increase as a capital contribution. It is written here. I'm not saying anything from my own end. It's written here. He will pay 35% of the excess of the list price over 18,000 pounds. The planned list price can go up to 24,000 pounds. List price can go up to 24,000 pounds, which means Marvin's capital contribution can go up to 24,000 pounds minus 18,000 pounds, that is 6,000 pounds multiplied by 35%. I know that it's a bit different perspective of looking at the benefit, but I will repeat the things again so that if you have any query, it will get clear. The capital contribution will go up to 2,100 pounds. This is within capital contribution permitted of 5,000 pounds. Let me repeat it again. See, we have to look at two possibilities. Possible increase in the list price and possible increase in the CO2 emission. Current list price of the car is 18,000 and CO2 emission is 140 gram. Current. This CO2 when converted to the car benefit percentage, it's 33%. Okay. For 55 gram, it's 16%, and then for every 5 grams extra, it increases by 1, which gives 17%. So the total car benefit percentage is 33% and the list price currently is 18,000. Now, if list price of car goes above 18,000, Morvin will pay 35% of that increase. It's written here. Morvin is saying that he will pay 35% of the excess of list price above 18,000. So the list price of the car can go up to 24,000 pounds, which means Morvin's capital contribution can go up to 6,000 into 35%, 2,100. Permitted capital contribution for car benefit for an employee is 5,000 pounds. Okay. For every extra increase of cost of car by 1,000 pounds, car benefit will increase by how much? 1,000 pounds, just use your mind, multiplied by 65%. Because 35% is the contribution done by Morvin himself. So obviously that won't be included in the car benefit calculation. So that gives us 650 pounds multiplied by 33%, which is the CO2 percentage. So 650 pounds into 33%, that gives us 215 pounds. Now you must have some questions in your mind. Okay. Increase in list price is multiplied by 65% as 35% will be capital contribution by Morgan. That's why it will not be included in benefit. Okay, when I'm paying myself, okay, then it will obviously not be included in my benefit because that's my own amount in the car. Okay, and CO2 emission percentage is 33% currently. Okay, we are assuming that list price will increase, but CO2 emission will remain constant in this evaluation. See, we cannot increase both of the things together. First, we are looking at the possibility of increase in list price. I know that you may have some queries in your mind that, sir, how did he ask us this question? It's a different nature of the question. He gave you a very good planning perspective. He said that the list price of the car may go from 18,000 to 24,000 and CO2 emission can go from 140 to 160. But we don't know exactly that what will be the situation. So we are talking about increase in list price. We talk that what is the current position. If the list price goes up, for every excess above 18,000, he will be paying 35%. Okay. Maximum, he will contribute 2,100, which is within the capital contribution limit of 5,000. So now for every extra increase of cost of car by 1,000 pounds, car benefit will increase by 1,000 pounds multiplied by 65%. Because 35% will be the capital contribution by Morvin himself. So if it's my own amount, obviously that won't become part of the benefit. If you remember the calculation of the list price, we remove our capital contribution from the cost of car. Okay. CO2 percentage is 33% currently, and we are assuming that list price will increase, but CO2 emission will remain constant in this evaluation. Okay. Change in list price of car will not have any impact on fuel benefit. Okay. Only impact will be on the car benefit, and the car benefit will increase by 215 pounds for every extra increase in cost of car by 1,000 pounds. As the cost of car increases by 1,000 pounds for every extra increase, our car benefit will be increasing by 215 pounds. Why? Because the cost of car increased by 1,000 pounds, 35% will be paid by Morvin, 65% will be paid by the employer, which will be his benefit. So 650 pound will be the amount included in the car benefit working. 33% is your CO2 emission percentage. Now looking at the other possibility, increase in CO2 emission of the car. Then what will happen? Let's look at it. If the CO2 emission of the car increases, currently car has CO2 emission of 140 grams and car benefit percentage is 33%. If CO2 emission of new car increases and goes up to 160 grams per kilometer, then for every extra increase of 5 grams, car benefit percentage will increase by 1%. Will increase by 1. It will go maximum to how much? 160 minus 140 grams. So it is an increase of 20 grams divided by 5. So it will increase maximum by 4%. Okay, it will go maximum to 33% plus 4% additional. So that will go up to 37%. It is the maximum benefit percentage which can arise. Okay, assuming that list price of the car will remain constant in this evaluation at 18,000 pounds, for every extra increase in CO2 emission by 5 grams, car benefit will increase by how much? 18,000 multiplied by 1%. So that gives us 180 pounds. See, at one point of time, you will increase one variable. You cannot increase both variables together. First, you looked at the situation when you were increasing the list price. First, you looked at a situation when you were increasing the list price. Now you are looking at a situation when you are increasing your CO2 emission. Are you getting my point? So for the list price, we kept CO2 emission constant. We kept the percentage at 33%. That was 140 grams. We said that, okay, if the list price increases by 1,000 pounds, 35% will be paid by Morwin, 65% will be his benefit. So on 650 pounds, 33%, 215 pounds will be the additional car benefit arising on every 1,000 pound increase on the list price. If the CO2 emission increases from 140 gram to 160 gram, for every extra 5 gram, it increases by 1% in your car benefit. Okay. So now it can go up to maximum 37%. Your maximum car benefit percentage which can arise. Okay. Which can arise is 37%. You know that car benefit percentage cannot go beyond 37%. So now assuming that list price of the car will remain constant in this evaluation at 18,000. Now we are keeping the list price constant at 18,000. For every extra increase in CO2 emission by 5 gram, car benefit will increase by 180 pounds. Fuel benefit will increase by how much? Now if you remember, in fuel benefit, the scale for fuel benefit for the current tax year is 27,800. Okay, will increase by 27,800 into 1%, 278 pounds for every extra 5 grams increase in CO2 emission above existing car CO2 emission of 140 grams per kilometer. Now, I know that you might have some questions in your mind and you must be expecting that, sir, please repeat it. Yes, I will repeat it again. See, the question was that how the change in the list price and the change in CO2 emission will impact his car benefit. Explain the amount which Morwin's annual taxable benefit in respect of the car and petrol would increase, depending on the list price and CO2 emission of the car she chooses. So we said, okay, there were two things going on. Current car of 18,000 may go up to 24,000. Current CO2 emission of 140 can go up to 160. Now there was a confusion how we can increase both of the variables. So we broke it into two parts. We said, okay, if the list price increases, so from 18,000 for every thousand above, he will pay 35% and company will be paying 65%. So the benefit will be on 65% portion, assuming that CO2 emission will remain constant. 650 into 33%. For every £1,000 increase on the cost of car, your car benefit will increase by £215. And when we talk about change in CO2 emission, your current CO2 emission is at 33%, 140 grams. For every 5 grams increase, it increases by 1%. So you may go up to 37%. Now we said that, okay, if the list price remains constant at the old car value, which is 18,000, for every extra increase in CO2 emission by 5 gram, car benefit will increase by 180 and fuel benefit will also increase by 1%, that is 278 pounds. Okay. So, yes, I would say that this part, last one, was something which require good evaluation skill at the students at. Otherwise, if I look at this entire answer, it's all done. If I look at the entire answer, it was very easy one. Requirement relating to ethics, very easy, very straightforward. Then in relation to this, acquisition in Remoil Limited, trading loss restriction, capital loss issues, very easy thing. Sale of share building, believe me, very, very easy discussion. Then there was VAT group implications, write-off of a loan in case of closed company situation, and this last part in relation to the change in the car and fuel benefit as the cost of the car increases and the CO2 emission also changes. I hope that you all have understood that how we have dealt with it. I have tried to repeat the things as much as I can, but still students may have queries in their mind. So there is nothing to worry. You all have my direct WhatsApp number. Okay, here it goes. You can always contact me. If you have any query, you can always ask me. Okay. Now, in the next class, we'll be looking at question number 2 and then question number 3 of this official mock exam. I hope that my today's discussion have added value towards your preparation for the examination. If you have any query, do share with me. I'll be more than willing to answer that. Okay. Thank you, everyone.